quick. What's the best performing restaurant stock in the Russell 3000 this year? It's not Wingstop, which is having another great year, up 46%. It's not Brinker International, parent of Chili's, up 54%. It's not even Cramer fave Cava Group, the valedictorian of the IPO class of 2023, up 129% year to date. No, the best performing restaurant stock this year is Sweetgreen, the salad chain, with a stock that is nearly tripled.
That was easy.
That's a pretty shocking number, not only because this has been a tough year for the restaurants, but also because not that long ago, Sweetgreen looked like a total dud. This thing came public in November 2021, right near the peak of that period for the highest growth stocks, remember? And at $28 per share, then the stock doubled in the first 2 days of trading, jumping to the mid-50s. But like so many IPOs of the 2021 vintage, the darn thing just collapsed. Ultimately bottoming at $6 and change in March of last year, down nearly 90% from its highs. This one was one of the goats of the game. While I like Sweetgreen, the restaurant, and a lot of people in the office really love to take out from there, I've been a true hater of Sweetgreen, the stock, ever since it came public. I told you to steer clear of it in November 2021 and then reminded you not to stick your neck out for an unprofitable company in June of 2022. Hey, those turned out to be good calls, as this thing was still trading in the single digits as recently as January. But I never really circled back to the story after Sweetgreen found a bottom, which is why its spectacular rally this year did catch me by surprise. So what the heck changed to make this stock such a winner? First, looking strictly at the numbers, Sweetgreen is consistently generating earnings before interest, taxes, depreciation, and amortization. They had positive EBITDA in 4 of the past 5 quarters, highly unusual. That's a much more forgiving metric than earnings per share, but at least companies moving in the right direction on the profitability front. Second, and more important, the same-store sales growth, how we really measure things around here, has come roaring back. Sweetgreen was putting up 25% same-store sales growth when it came public in 2021. Clearly not sustainable. Slowed to 13% in 2022, then 4% last year. In the last 4 quarters, though, their comps have re-accelerated. Last time the company reported, they were up 9%, match projecting 5 to 7% growth for the full year. That is fantastic. How did Sweetgreen generate those numbers? For starters, I think their focus on healthier meals and a more affluent customer base gave them a structural advantage at a time when the broader quick-serve industry struggles with pushback on pricing from lower-income consumers. Plus, they made some big improvements to their loyalty program, and they already had a strong digital ordering system. A lot of companies don't have that. But mainly, Sweetgreen stopped being so hung up on the idea of being a salad place. In the past, they've been occasionally introduced different seasonal salads, which never really drove new traffic. Last year, though, this salad chain started selling something other than salad. They made some big bets on protein, starting in the spring of 2023, when they rolled out a chicken burrito bowl with 0 leafy greens. The change really began to take hold last fall when Sweetgreen decided to tackle dinner with new protein dishes, including a very good miso-glazed salmon plate. And the company keeps getting better and better at this type of thing. This past spring, they went all in on the new strategy. Now you can get a caramelized garlic steak from Sweetgreen. Sounds good, doesn't it? Well, not if you're a vegan. When the company reported its most recent results 2 weeks ago, that steak was the first thing management cited to explain the terrific 9% same-store sales. So it's actually a fun conference call after a lot of sturm and drang. These new non-salad options have brought in lots of new customers, while improving traffic both during dinner hours and on weekends. Makes sense. They sell actual meals now. People are happy eating a salad for lunch, sure, which is why Sweetgreen's always crushed it during the part of the day. But they struggle later in the day because salad for dinner sounds a lot less enticing. So it's menu innovation and the embrace of protein. That's what's driving Sweetgreen's revenue growth. At the same time, they've embraced efficiency in order to bolster the profitability. Managers made some big investments in automation, the infinite kitchen concept that allows them to prepare food faster with fewer people. And you can actually watch the machines at work. Well, this technology only has been rolled out at a couple locations. Their restaurant margins are already 10 percentage points higher than the fleet average. That is gigantic. This year, Sweetgreen's plans to open 24 to 26 new locations, 7 of which will have the infinite kitchen technology, while another 2 or 3 locations will get retrofitted. During the dark days of 2022 and 2023, when the stock was getting killed, management promised to dial back their store growth ambitions, wanted to focus a little more on profitability. And now they're very much delivering on that promise. Others I know are still in a hurry to put up stores. I say, here's your hat. What's your hurry? Don't let the door hit you on the way out if you're just putting up stores for empty calories. At this point, Sweetgreen's ready to start really expanding again, but at a doable pace. When the company reported 2 weeks ago, CEO Jonathan Neiman said the plan is to go back to new unit growth of 15 to 20% per year. Given that they currently have 225 locations, that would mean roughly 35 to 45 new ones next year. That is a manageable pace, people. And since they figured out how to generate more traffic while running a tighter ship, adding new stores has become a much better business proposition. So now for the million-dollar question. Is Sweetgreen, the stock, worth buying up here, even though it is nearly tripled year to date? Some say no. Stock was up a lot before Piper Sandler downgraded from overweight to neutral. Monday really caught my eye. Sent the stock from 37 to 33 and changed over the past 2 days. But that pullback happens to be the reason I'm willing to endorse it. When I look at the Piper Sandler downgrade, you know what? I didn't see all that much to be worried about. This was part of a broader bearish call in the fast casual dining space. In fact, if you look at the report, it actually reads more positive than negative. But before the analyst concludes with, quote, we think the risk reward has become more balanced at current levels, end quote. End quote. We wouldn't be surprised if absolute share price upside was a bit harder to come by over the balance of this year, end quote. That's hardly a vicious takedown, right? Given that the stock's now pulled back 12.5% from the last week's highs, I'd be tempted to start building a small position in Sweetgreen. However, considering that we're headed into a seasonally choppy period for stocks, I wouldn't be surprised if this one gets knocked around a bit. Maybe you get a little bit in now and you buy some at lower levels. But the bottom line, if Sweetgreen stock keeps getting slammed like it has earlier this week, I think you should pounce. Because this is no longer the unprofitable salad chain of 2 or 3 years ago. Not only does Sweetgreen get religion on profitability, it eagerly slaughtered the sacred cow of being a pure salad chain, and now it's serving that cow for dinner.
House of pleasure.
You got my blessing to pick up the stock here, and then maybe buy some more if there's additional weakness, something that might be given as the rotation inside the restaurant group is about as vicious as they come. Mad Money is back after the break.
Coming up, are the charts of a Cramer favorite signaling softness? Cramer chews on the dog days of summer. Next. Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.